I would actually love for you, Neil, to give us a crash course on self-storage. And kind of what you guys look for. Do you develop them? Do you buy already stabilized self-storages? Like, what's the business model? How does it all work? Would love for you to give our viewers and ourselves a crash course, please.
So storage, it's a very simple asset class. Pardon me. Caught what you had, August. It's a simple asset class. It's a commercial asset class. It basically involves renting people boxes of air. Most storage operators will keep things simple. People are renting on a month-to-month lease. You don't have long-term leases. Oftentimes when people rent a unit from you, most people expect to be there 3 months. The average person rents a storage facility for about 18 months on average. And so usually what will happen is you'll move your stuff into a self-storage facility, and then you will, you'll come in at a certain rate, and within usually about 3 months, they're going to raise your rates about 10, 15%, which is usually not enough to get most people to move out. And then the longer you stay there, usually every 3 months, so you're usually going to do rate increases until people cry uncle. As an asset class, it's got a lower expense ratio than multifamily. Multifamily will tend to be about 50% of your expenses are going to go out to expenses, not including debt service. Whereas self-storage, it's typically a lower expense ratio. It's around 30%. So you get to keep almost 70% of whatever your gross revenues are, of course, not including debt service. There's typically, I would say, 4 to 5 primary strategies with self-storage. There's buy an existing facility and expand it. It's got room for expansion. You can buy an existing facility and do an operational turnaround. You're just, raising rents. You can develop from the ground up, or you can do self-storage conversions. You can take an old, empty, big box retail building, like an old Kmart, an old warehouse, an old mill, whatever, an old office building sometimes, and convert it to self-storage. And then obviously sometimes there's where they just buy existing, and they're just buying cash flow. There's usually somebody who's borrowing at a significantly lower amount than the federal rate. They're usually using insurance money to buy it. We like the conversion strategy because it's sort of the best of what we like. Heavy value add. We're typically if you or I were to go out and build a facility from the ground up, on average these days it's going to cost us about $120 a square foot, not including the cost of the land. And then it's going to take us anywhere from 12 to 36 months to entitle the land and to prep the land before you even really start to turn a shovel and start to put up the bricks and sticks. With conversion, we're typically buying on average for about $25 a square foot, oftentimes below the replacement cost. And then we're usually doing the conversion for about $45 a square foot. So on average, we're all in for about $65 to $70 a square foot. And that includes the cost of land, the building, the conversion, everything. So we're in, and it typically only takes us about 12 months from the time we acquire the building to the time that our doors are open. So we're cheaper and faster to market.
And then let me ask you, what does it look like as far as what's your business model? Are you looking to hold it long term? Are you looking to, hold it for 3 to 5 years, 2 years? Talk to us about that.
So when we started off, we really wanted our idea, and it's our preferred exit, our preferred business plan is to buy and hold for the long term with our investors. We create such significant value in year one that we're typically, if lease up goes the way we project, around year 5, we're able to do a cash out refinance, which comes out 100% tax free for the investors, without stressing the asset. And then everybody stays in it long term. We continue to cash flow. Now, obviously it's very market dependent, both on the local market and also the macro market. Interest rates have shot up significantly, in the last 3 years. Sometimes it doesn't make sense to do a cash out refinance. And also, it just doesn't, it also doesn't often make sense to hold it long term. There's an awful lot of money that's coming together in the last 12 months to buy self-storage. And so we're starting to see a period where cap rates are going to start compressing again with self-storage because there hasn't been a lot of construction in self-storage. It's been dropping in the last 3 years. because the interest rates were so high. But there's a lot of capital out there chasing them, a lot of institutional capital chasing those facilities. And we think there's going to be an opportunity to do holds where we're only doing 3 to 5 years.
Okay, well, you mentioned cap rates. Let's talk about cap rates. What cap rates ranges do you typically acquire self-storage at?
We don't buy on a cap rate because we're not buying an existing facility that has income. I mean, our cap rate is zero, really. We're buying a nasty old vacant building that's been sitting empty for 5 to 10 years. It has, we bought a old vacant Piggly Wiggly, which is a grocery store here in Macon, Georgia, that had been vacant for 10 years. It had a tribe of meth heads living in it for several years. It had every piece of copper stolen out of it. It really, it was the only value of the building was essentially whatever somebody was willing to pay for it. And so it was really the value of the land.
Okay.